It's Wednesday, the 11th of March, 2020. It's about 9 p.m. Australian Eastern Time. I wanted to do a video of some of the macro charts. I've had a few people ask me. Obviously, it's been a pretty eventful time in world markets the last couple of days, and I didn't have time to do a video on the weekend. But I thought it would be a good opportunity now. I've been able to sort of collect my thoughts, just going over some of the charts, and that's why I find charts useful, is you can sort of start to see how different asset classes are moving as well. And I think this macro environment is really important at the moment, and that's kind of what I wanted to talk about today. Obviously, gold price been pretty volatile around this sort of, it peaked above 1700 on Monday when the world markets were really crashing, and we had that sort of one of the worst days in the last 12 years since the financial crisis on Monday across almost every market, but down about 7 or 8%, and I'll talk about that and some of the index charts in a minute. But the gold price, 1700's been my target for a while out of this, and that's really that was the target of this head and shoulders bottom that formed sort of 2013, 2019. And that was this basically the breakout move from that sort of 1350, 1370 zone was around this 1700. So that's been a target for a while now. I never thought that was never the ultimate target. There was a target that that was the first stop out of this move. And I think what we're really seeing now is, I think charts, while I like to use charts, I think some of the macro, the central banks and the political moves that are going to happen in the next few months, and perhaps even sooner, probably make the charts a little bit redundant. I think there is, from a short-term perspective, I think we're due for a breather in the gold price. That's what the chart's showing. It's volatile here, but even if we can go have a similar move to this, which lasted a couple of months last year, and work off some of the excess in the market, I think that would be a very positive sign. I've read a lot of stuff recently about I think there's a tendency for gold investors to really relate what's happening now to the 2008 crash. And I talked about that in the last macro video I did a few weeks ago. In the 6 months, or 4 to 6 months when the real peak of the financial crisis, the gold price went down sort of about 25 to 30%. And that was really a liquidity crisis where everyone was rushing into US dollars. And I think one thing that's kind of different now is I think the best way of viewing gold is real yield if real yields are negative. And when I say real yields on the 10-year US government bond, when that goes negative is usually the best time for gold. What happened during the financial crisis actually is that real yields was still very positive during that time. You can see here in this period I'm talking about, where the real yields were spiking, gold price was falling heavily. So that is the period. But what do we have now? We don't have that sort of environment. In fact, this is an updated chart. Real yields, inflation is actually on the latest stats, I think has been at the top of the Fed's target band for a while now. It's sort of trading above 2%. And on the 10-year government bond, we're trading down below 1% right now. And that's a different environment for gold, where you're not going to see that 2008 type move where people are moving into. You might see it moving into US dollars, but back then they were yielding. It was a significant yield you could still get on US dollars in treasury bonds. You can't get that anymore, so you're actually still getting negative yields, and that's the case all around the world now. I mean, the market's pricing in another 0.5% Fed cut, I think, or even more. Basically, all the ammunition that could have been used out of this, what they built up when they raised interest rates in 2017 and 2018. That's basically they've fired within the space of a month or two. They're going to have fired all their shots from an interest rate perspective, and that's the case. I think the Bank of England just cut rates by 0.5% down to 0.25%. Obviously the RBA is down to 0.5% now. Probably expect another 0.25 point. So we're pretty much going to be, I think the ECB decision is tomorrow. We're going to be at near zero almost everywhere by in the next month. So then you start to talk about unconventional policies, and um, I think from the what we're seeing with the US dollar index, for example, here, you know, we're not seeing a strengthening US dollar like we saw in 2008. And I've highlighted that period. Obviously this is the period here of late 2008, and obviously that real strength of rush into US dollars, that safety move. But I don't think you're going to see that, and we're not seeing that at all right now. Is where we saw the US dollar sell off hard last week. So the safe haven currencies are really, the Japanese yen and the Swiss franc and the euro to a lesser extent as well. So that's where money's been going. When the currency, when these interest rates all normalize at the same numbers around that sort of 0 to a quarter% sort of range, then I guess you'll start to see the moves, and I start to see some more interesting moves. But in the short term, we've had that correction, and I think the spot Australian dollar price, I've talked about this for a while. That obviously had this big fall the other day on Monday as well. Bit of a flash crash in the Australian dollar. Very similar to some price action I remember in early 2019. I think this was brought on by about a surge into Japanese yen as the US dollar was falling, and the Australian dollar was falling even faster. So you can see that candle I'm talking about right there. That was very early 2019 and marked the high in the Australian dollar gold price for a while. But I still, from an Australian economy point of view, I still think when these interest rates, what we're seeing in the last couple of weeks in the Australian dollar is that we're seeing money move out of the US dollar, and that's given the Australian dollar a bit of a bounce because that interest rate differential that had been there is closing now, and you're going to see that the gap, as I said, close worldwide where all the interest rates are going to 0 or a quarter%. And now then you start to trade on, I guess, economic fundamentals, and that's where I believe the Australian economy has that soft underbelly that I've talked about a number of times in these videos. And I think it's the old sort of the Warren Buffett quote, when it's only when the tide goes out you see who's swimming naked. And I think in Australia in particular, that's a real problem. And we've seen the iron ore price hold up quite well in the last couple of weeks. This is a chart from Macro Business. They do some pretty good work, and been following them for a while. The iron ore price is still staying pretty stable compared to, and most commodities are as well, aside from oil, which I'll get to. But I think there's this tendency in environments like this to sort of look at these short-term moves and say, oh, this asset class is stable, and therefore things are going to be okay. And I think there's a real danger in looking at these just short-term moves and saying that asset price is going to stay where it is. I can't see how iron ore stays at these levels if we see sort of worldwide recession that everyone's talking about. And I think that would drag down the Australian dollar, for example. And I think other commodities are probably going to fall into the same boat. And that's it's and the same with house prices, for example. You're seeing people say that they're a safe haven asset in this sort of environment, which is just ludicrous. All it is just a lag between financial markets which operate on a daily time frame, or a minute by minute time frame, and housing markets which have a lag of maybe 3 to 6 months, for example. So you're going to start to see that filter into other asset classes. So I'd be cautious about looking at and people saying that things are a safe haven without understanding how the feedback is going to work in sort of economic environment. We saw that the Australian government's going to announce a stimulus package tomorrow, which I think is in the order of $15 to $20 billion. I think that's going to be a drop in the ocean and not going to be enough to spur markets at all. The S&P 500, obviously very interesting chart the last couple of days. Down, spiked up again last night, but I think the S&P futures I just looked at are down about 2% right now. So it still looks like this volatility hasn't gone away. The US government's trying to do something similar to Australia, where there's it's talking about stimulus and saving, forgiving loans for oil companies, or some sort of debt forgiveness there, or a helping hand of some sort. But and payroll. I think I read about payroll tax relief, all sorts of ideas. But this stuff is they're really just trying to create a confidence. And I don't know. I think when I was looking back at the last two real bear markets, the 2001 dot-com bubble and also 2008. Just get that chart the right sort of. You can see there that these periods, the market didn't in 2000 and 2001, 2, for example, the market was basically going down for 2 years on the S&P 500, and 2008, 2007, 2008 was a bit of a faster move, but we're really only at the start of this thing, and I think you start to see the real economic impacts of this are going to be felt for a while, even if coronavirus sort of if all the best efforts of governments and health organizations and all that, they are able to tackle this thing and bring it under control, you're still going to see, I think, a minimum 6 to 9 months of deep economic sort of malaise and probably worldwide recession. So I think the market's really, just to people talking about V-shaped recoveries and stuff, this is just the start of a downtrend. I think, we're 2 weeks into this thing, and these previous bear markets lasted 2 years. I think there's a tendency for people to believe that the sort of financial wizards can really save these things with a big bounce back like we've seen pretty much every time in one of these down moves for the last 10 years. But this is really going to affect the economy broadly in most countries, and particularly an economy that's reliant, as in most of the Western world, is reliant on consumption, and freedom of movement of people, for example, and traveling, and all that has basically ground to a halt, or to a large extent. The huge drops in air traffic, and I struggle to see how this doesn't last for quite some time. So people talking about V-shaped recovery, I think you've got to be very careful listening to those people. But the ASX 200 had another terrible day today. It's interesting, when I was looking at this on the weekend, I had my my big red lines here that from the last 10 years of ASX moves. And if anyone's been watching these videos for quite some time, I've always had this nice parallel channel here, and Monday reminded me a lot of. Sorry, Tuesday reminded me very much of a day in 2011. I remember I was watching the markets then when the everything was really crashing. Just get in here, and the market gapped down intraday, plummeted about 4 or 5%, and then bounced back up. And that was right at this trend line, and that's what we saw on Tuesday. But this action today, very bearish. So, again, I would be cautious about people trying to pick bottoms here without sort of understanding the broader economic flow-on effects of this. So I think this has got a ways to go yet. So, oil was obviously the other interesting market, and that's kind of, no one really saw that coming until maybe toward the end of last week, when it looked like the OPEC negotiations with Russia were going to kind of break down. Obviously, that's added fuel to this fire, and I think that looks like it's going to last for quite some time as well. There's a sort of a supply war going on now. The Saudis are going to up supply. It reminds me a bit of in 2014, 2015 when we had this. I remember getting burnt in some of the oil stocks when I tried to jump in too early, and I feel like we're going to be rushing, knocking along these at pretty low levels for a while. I don't see how we're going to have a V-shaped recovery in oil either, with this huge demand shock coming at the same time as the world's biggest producers want to up supply and compete with one another aggressively. So that's a terrible that added to the move on Monday on world markets. You saw some of the ASX oil stocks down 20% plus, which is just pretty tremendous moves, and probably some of the biggest moves in history, I would say, even more so than in the financial crisis. But that's sort of neither here nor there. I guess it's, from a gold producer perspective, it's actually quite a positive development, because for companies that have a large portion of their costs in for trucking, particularly for open pit miners where they've got a lot of diesel costs, and also for remote sites which rely on diesel for power generation or fuel oil or all these sort of things. All of that relates to the oil price, and I think for some producers, I know it's their largest input cost. The Australian dollar gold price obviously peaked up on almost got to 2,700 with that flash crash in the Australian dollar on Monday. It's holding fairly well at these sort of 25.40 levels. Obviously, the ASX gold miners got absolutely hammered today. Another down, many of them down sort of 7 to 10% among the mid to large cap names. I probably won't go into that too much. I might just have a look at a couple of charts there. Regis, for example, I think was down 9%, one of the worst performers. Gold Road, I think, was down heavily as well, down about 9% as well. So this is, those two companies I just mentioned, Regis and Gold Road, they're probably among the biggest beneficiaries from a falling oil price in terms of their diesel costs. Big open pits, low grade, remote sites. Although I think Gold Road's plant is gas based, at some point those prices link back to the oil price. So there's going to be I guess the point there is that in the short term, the market's volatile, but that might have a $50 to $100 impact on their all-in sustaining costs, that fall in oil price. So that's a real benefit at a time when the gold price is still holding up pretty steadily. The GDX, I'm rushing through a few of these now. I'm getting there's a few too many charts to talk about in the time I've got, but the GDX holding relatively well above this 26 level. I guess the miners could be predicting a move further down in the gold price, but I'd like to see, if the markets can stabilize a little bit, I want to see some money start to come into these large gold miners, and I think that will happen. I think people will probably start to cotton on that that central bank moves are going to be positive for gold in the medium term, even if it means a bit of a short term volatility and maybe some down moves in the short term. But as I said, I think that chase for chase for negative yields is going to push gold prices higher as people look at that as an alternative asset, and eventually that will translate into these gold miners. But they're trading more like equities. They're just trading with everything else at the moment. They're not trading like gold equities, and I think that will come. But it's there's a short-term volatility here. So GDX is holding okay, and I think there's sort of a bit of a lag here. The Australian miners and the Australian trading is almost leading international trading. And I think I saw the Australian the GDX on the ASX today was up about 4% at the same time as all the gold miners were down on the ASX were down sort of 7 to 10%, which is the GDX is really just based on what happened last night in the US, which was a relatively positive day for gold miners, but perhaps you'll see the GDX come off sharply this evening in line with the moves on the ASX today. So it's hard in these volatile markets to see which markets are leading. But as I said, the GDX, the big gold miners are really trading more like equities than they are gold equities. The GDXJ has been very similar sort of chart, trading at around this sort of support level here. You wouldn't say that's positive price action at all. It looks pretty negative there. I've been keeping a little bit of powder dry and buying gradually into some of the more quality names that I think if I can pick them up cheaply, that I'm looking to hold for the medium longer term as well. So that's a big sort of a quick rundown of I've tried to fit in a lot there in a short time, but I think watching these, you really got to look for the big macro trades at the moment and what that's going to have implications for the medium term in gold prices. And I still struggle to see how an environment of interest rates at zero, negative real yields across the world, basically. Inflation is still relatively strong, but there'll probably be some deflationary effects of this coronavirus. But central banks are going to do everything possible to avoid a deflationary scenario. So you're going to see I saw some stuff about, there's some comments from the Deputy Governor of the Reserve Bank today talking about buying government bonds. Really ridiculous stuff, considering Australian government bonds are already trading at really low yields. It's not going to have any effect on the real economy and borrowing capacity of governments, or to be able to borrow at 0.5% versus a little bit less than 1%, for example. So kind of ridiculous stuff, but that's always been, they're always going to do what's been done elsewhere because it's believed that these policies have worked, and QE is the right thing to do. But there's from a gold price perspective, I think there's a real possibility that things start to get a little bit chaotic in terms of if the central banks really step in here and do some of the things that have only been talked about in theory for the last few years. We kind of don't know what comes next, and if they step over the line where the market really sort of starts to question whether they can hold this together, you could see a bit of a rush into gold. I'm not saying that's going to happen, but I think in times like this, it's chaotic, and there's a real possibility of sort of a loss of confidence in central banks to keep this game going, and you're seeing that on share markets. The S&P, for example, in particular, that's what's going to hold that together. They've already cut interest rates. The market's already pricing in basically zero interest rates within the next couple of months. So if they don't prop it up soon with some real heavy QE of some sort or other alternative policies, you could see bigger falls, and they can't really have that, particularly with it in an election year for Trump, and he's tied himself to the S&P, and his success is going to be judged on the stock market, and he can't have that, especially in the election year. So that's a quick run through, and as I've said previously, if you want some more insight into gold stocks and the gold markets, I do these videos on the Patreon channel as well. I'm putting more and more content on Patreon. So if you want to follow there, I'll put the link in the video in the comments under this YouTube video, and you're welcome to ask me questions about individual stocks there, and I put up regular videos every week. Thanks very much.